water is important when you're using your mouth. You know, a great actor can just read the phone book and it will somehow be compelling. And on that note, I actually read this book on Kindle and copied so much out of it because it was so useful to me that Kindle said, you've copied too much from this book. And so now I've had to like take screenshots and write notes, but I've really gotten so much out of it. The best and worst managers drive their employees as hard as they can. A lot of things that were done in business are illegal. Now, if a person's successful, they may be held up like it's great that he didn't let the law. In the case of this one, who was Vanderbilt building the railroads in New York, Vanderbilt wasn't constrained by the law. Could easily have been. Vanderbilt was a lawless criminal. There's 20 chapters in the book, 20 great takeaways, I think, but I found 6 that really resonated with me the most. Understanding what enough is one of the most interesting ideas, and he reframes it to say, enough is not a little. Enough can be a lot. And I remember writing to my note, I have a note here, I have this problem with cookies and ice cream. I'm insatiable when it comes to sweets, but I haven't blown myself up, unfortunately, at least not yet, with cookies and ice cream and cake. But people who have a tremendous amount of wealth have blown themselves up. You know, after this book was written, there's a great story about a guy named Bill Wong who managed one of the tiger cubs. This guy was a billionaire. And he took his $20 billion that he had and put it all into Paramount stock. That was a new streaming service at the time. And the stock went up from like 20 to 50. And he was now going from $20 billion to $100 billion. And he's the smartest man in the room and everyone's thrilled. And then the executives at Paramount said, our stock is way overvalued. Let's issue a secondary offering where they tried to actually participate in the wealth and manipulation that Wong was doing to their stock. And of course, when a company issues a secondary, the stock falls. Well, Paramount stock fell because Paramount wanted to take some money into their books from their high stock price, and there were no other buyers except this guy, Bill Wong, and his own money. The whole house of cards fell, and this guy lost all his money. He was fabulously wealthy. He was going to become fabulously wealthier. More Picassos, more jets, but now no jets for Mr. Wong. You know, Rajat Gupta from McKinsey did the same thing. He's the CEO of McKinsey. You can't be more successful. He heard that Goldman Sachs, his client, was going to be bailed out during the financial crisis, I think. They have records. 16 seconds after the call, he calls up his insider trading buddy, violates his oath, commits a crime, puts his entire career at risk, and lo and behold, ends up serving 2 years in jail. This guy was on top, but he was unable to really appreciate that he had enough, and he had a lot. And there's so many stories like this. They're kind of, you know, schadenfreude is the feeling, and it's something I kind of enjoy. We've all got to decide for ourselves what enough is, and what Housel points out is don't move the goalposts. If you get enough, you know, congratulate yourself, be happy, ratchet down your risk, relax, focus on other things. Reasonable is better than rational. And what that really means is a plan you can live with that exposes you to volatility that you can tolerate is much better than some hypothetical wealth maximizing strategy like 100% equities or levered up equities. You know, there's a reason people own bonds. It's not because they're high return, it's because they tamp down volatility and risk and therefore will hopefully allow you to relax and stay the course. You know, I look at my portfolio during a time when crypto is down a lot, high-flying internet stocks are down a lot. I'm down, but not quite as much because I have some cash, I have some real estate, which is thankfully not priced, and I have some bonds. And so the whole thing means that I don't go up as fast when things are good, and I'm not going down as fast when things are bad, so I can kind of relax a little. It's not value maximizing. Maybe I should be all equities. That would be the rational but unreasonable approach for me. I would lose my mind. So much is new and poorly understood. Retirement is such a recent invention. Very persuasively, Housel explains, labor force participation for people over the age of 65 was nearly 100% before World War II. And it's only recently, over the last couple decades, really ratcheted down. Social Security, when it was started, only paid out a modest amount. It was really trying to keep people out of extreme poverty and old age. So all these things that we've accepted and come to believe have always been like this are actually not. They're new things, and the whole idea of individuals saving for their retirement is an entirely new venture, so it's very normal for them not to understand and not to do well with it. And that's why a book like this is so helpful. Really surprising to me just how many things I didn't know even after spending most of my life working in the financial industry and thinking about this stuff pretty much 24/7. Nothing is crazy. No one is crazy. When you look at something you don't understand, my natural reaction is that's crazy. You know, something like, again, I don't really understand crypto, so I'm pretty dismissive of it, but people who thought more about it than me were willing to pay $60,000 for for it. Maybe it'll turn out not how I expect. I don't know that much about it. I should be humble. Nothing is as good or as bad as it seems. This is about mean reversion. When markets are down and everyone is in despair, things have throughout history recovered. And when markets are at a peak, they tend to go down. You know, the amount of time markets are at their peak is actually very small. Most of the time, markets are trading below their peaks and above their lows. They're somewhere in the middle. And that's what's to be expected. You know, when things are at a peak, likely to come down. When things are at a trough, they're likely to come back. That's just mean reversion. We've seen it over and over again. And he supports that point by talking about how we shouldn't take too much from extreme examples. Broader patterns are more useful when thinking about how to make decisions than looking at extreme case studies, because luck and chance have so much to do with each individual study. The last point that I thought was really interesting is the idea of the seduction of pessimism. There's many people out there in the financial community who will say, things look bad, the stock market may fall, act now to protect your assets, I'm trying to help you, save you from loss. It's very natural to think these people are trying to help, and maybe they are. But the flip side of that is that they may take you out of the market when it recovers. If you miss the ups months in the market, if you miss the moments when the market goes up, your returns will not be good. So if you flee to safety, the studies show that if you also miss the recovery times, which are unpredictable, you're not going to have good returns. So as much as pessimism sounds helpful, sounds like you're reducing risk, it's actually very dangerous. There's 20 great chapters in this book. I found a lot of value in it. I think this book ultimately helps people hopefully remain calm during times of crisis in the market. That's really an invaluable thing. That's why Warren Buffett has been so successful. Warren and Charlie Munger, the two of those guys, somehow or other, when things are at their worst, they manage to have that longer term perspective. You know, I just watched Warren's authorized biography where he points out that his walls are decorated with headlines from history showing the worst events of the last 100 years. The crash, wars, all sorts of horrible things have happened. And by seeing that and recognizing that history continues, time moves on. After the crash, there was recovery. After the dot-com bubble, there was a recovery. After the great financial crisis, the Great Recession 2008, there was a recovery. After COVID, there was a recovery. Now, right now, what are we calling this? The inflation scare? I guess the rising rate scare? There have been dozens of recessions. There's always been a recovery. If you have that perspective, you're less likely to panic and hopefully, therefore, enjoy the recovery, which is where all the returns are made. So, you know, thank you, Morgan Housel. You've sold 2 million of these books already. I'm a little late to the party, but I appreciate being let in and learning. And this was the best book I read so far this year. Goldman Sachs